Hey, everybody. Welcome to the Fire Chat podcast, where we talk about financial independence through real estate. Today on the show, I have Mr. Steve Lazerson again, one of our bronze sponsors for the Inland Empire Real Estate Investment Club. Steve, say hi to everybody.
Hello, everybody. Glad to be here today.
Yeah, man. I think you're my, other than Caitlin, you're my first repeat guest.
Yeah, that's great. I'm glad to be on here.
Awesome. Well, it's great to have you. Last time we talked about everything from, I think we talked about cars and gas stations and,
Yeah.
we didn't get to hit too much on a lot of the mortgage side of things and the note side of things. So go ahead and give everybody like a quick, maybe like 30-second to a minute recap of like kind of your background and what you do in real estate.
Yes, of course. So my background, I started out in the kind of the exotic car business with antique and muscle cars. I bought and I guess mostly wholesaled and then retailed, flipped cars. Then I got into the restoration of the cars. I bought a paint booth. I learned to paint cars, and I did that for a while. And as the market changed on the cars, the prices started really ratcheting up, and I had, only so much money to work with. And I said, I'm not going to be able to do this forever unless I get a big chunk of change to buy some of these cars because, now they're just priced out of sight. So I started converting from just fixing the cars, the older cars, the muscle cars, things like that. And then I started doing smog and smog repair. And after that, I started getting into lending on real estate. And this was mainly private loans, started off mainly commercial properties. I was doing some gas stations, things like that. And then I would set up a business on a property. I would sell off the business, keep the real estate. And then later I would, sell the property, usually on a private note, collecting payments, things like that. So that kind of was my intro into the private money world. So that just kind of expanded. Now I've been doing it for over 40 years now. So we do all kinds of loans. We do all kinds of conventional FHA, VA, but I'm mostly known for, the private money more than anything, also business loans. So, what I like to do is we find clients that they will want to buy a property, and for whatever reason, maybe they don't want to go to a bank because they don't want to deal with all the paperwork. Maybe their credit's not perfect. Maybe the property they're purchasing is not in the best of shape. Or maybe the time frame they have is they need to close in a couple of weeks and they don't have time for a 30-day escrow. So that's where I come in, and we'll look at the transaction, and we're an equity lender. We look at people's ability to pay, and if they have some skin in the game, if they're putting a good down payment on a property, and we feel like they have the ability to pay, then we'll probably make them a loan. We'll go ahead and we'll normally do an appraisal on the property. And then how we come up with our money is we will get investors to give their money to us, and we will manage the investment for them. So, and all the people who will invest with us will go on the note, the deed, so they're secured. Other companies may pool money from investors, but they won't be directly on the trust deed itself. With our transactions, the people are all on the deed. We service the loan. We don't sell notes. And if there's any problems, the company I work for, Peak Finance Company, we have our own foreclosure division, so we would deal with that. So basically, the people just cash checks, and that's
Excellent.
what they like.
Excellent. And what was your, just to remind the people, what was your first deal that you flipped? I always love this one. Was what?
Well, the first deal was actually a gas station.
Yes, I love that.
Yeah.
So he talks about that in depth on the last episode that he was on. Just go back on YouTube and look at the or however you're listening to this, look for Steve's original one. It's a super interesting story on how he, most of us start off with a really small single family, or but you went full bore on a gas station. So
well, the prices were a little less back then.
Yeah, but still,
it was $120,000, and the seller carried most of the mortgage with a small down. And by him doing that, it opened up my eyes to the private money side of things. And we just paid him for a number of years, and then when the note came due, I happened to refinance with another private money person. And so it worked out good. The building, we rehabbed it. We actually put a business there to work on cars. We redid the station. The station had old gas tanks, so we had to pull out the tanks, replace the tanks, replace the pumps, do all that. And then we built up the business, sold the business, kept the property for a while. And then later on, a few years later, we sold the property to the owner of the business. So that kind of got us our start.
Yeah, for sure. I just think it's a cool story that most people kind of follow a path on flipping, and you were like, nah, this works. So so you were a numbers guy, from the beginning, that you could see something and be like, yeah, it's gonna work. So so I know you're a licensed broker, right?
Yes,
and,
I am.
You have different, like you started talking about a little bit, you have different assets and different sides of your business that you do stuff with. You do work with, regular home buyers and stuff like that for just your normal conventional mortgages.
Right.
FHA,
Correct.
all that stuff. And then you also get really creative and I think that's, one of your biggest strengths. And why, when you came on as a sponsor, I was really excited because you have that, like, you have that the both sides of the equation that some people, you'll do the hard money kind of stuff, but also do the conventional. So I think that makes you really, really versatile.
Right.
Cool.
Right. Because, I mean, I love the conventional side of things, but there is a lot of competition with that. It's almost like a commodity when you get down to conventional financing. It pretty much boils down to price and rate and fees. And so with the private side of things, it's a little different because even though there's still a lot of competition with that, the people are more open-minded because they're usually a little more experienced. They're not usually first-time buyers. They've usually, to also state, we're basically on the private side, we're doing loans for investment purposes only. So if somebody's buying a home to live in, we're typically not going to do a private money loan for them because the requirements to approve them are a lot more stringent.
And when you say requirements, is that like government requirements? Or?
Yeah, that's government requirements. So with the investment, we still analyze the deal, and we still ask for documentation like any type of transaction, but it's not going to be quite as rigorous as with an owner-occupied deal. And then when people, if they've got credit issues, where somebody came to me and they had, let's say, a 500 credit score, they're going to have trouble, getting any kind of a conventional, even FHA loan most of the time. With private money, it'll be a little different. We'll look at their resources, we'll look at the down payment, and we'll look at the ability to pay and what their story is. Maybe there's a good reason why the credit is so low. Maybe they suffered identity theft, or it could be a number of different reasons. So we have a number of loans on the books, people even below 500 credit scores. And the bottom line is if they have a property highly appreciated with a lot of equity. Our loan amount is fairly minimal. Chances are they're going to pay. They're collecting rents in the property, and the rents more than cover the mortgage. So we're still fine.
Awesome. So what would you say, like, is there a typical investor that you do lend to, or like a dollar amount, or like what's the business model?
Yeah, that's a good question. I mean, we'll do loans as little as $30,000, which most lenders, won't get involved in loans that small, and usually we'll go up to about $2.5 million. That's probably going to be the higher end of our range, and anything in between. And again, we'll look at the deal. We'll look at how much money is the person that's buying the property, how much are they coming in with, and mainly we focus on first mortgages. We'll do some seconds, depending, if the first isn't too large in comparison to the second. But a lot of times, people they'll line up $1 million first mortgage, and they're short. They need like 50 grand, and they say, well, the property is worth like $2 million, so there's plenty of equity. That wouldn't be a deal we would get involved in, because the problem is, yes, there is a lot of equity, but if for some reason the deal goes sideways, we don't want to be behind $1 million first with a small second, and then having to keep the first intact to protect our $50,000 investment. So that wouldn't be a deal that we would consider.
Would you do it the opposite, where maybe they have a small first?
Oh yeah,
but you'd have a larger second.
Yeah, if we've done that. Let's say somebody has a $200,000 first, and it's a conventional loan, and they've got a real low interest rate from a few years ago. They don't want to touch it, but they have a property. Let's say it's worth $1 million, and they need, let's say, a couple of $100,000. Yeah, that's a deal that we'll definitely look at, because the first is manageable in comparison to the second. There's still a lot of equity, and we understand the reasoning not to refinance the whole thing. So it's a win-win for everybody. Sure.
Right on. And I mean, do you do like normal, like just regular, like fix and flip loans, or?
We do. Yeah. We do fix and flip loans. Now, the thing with fix and flip loans is we do require, a certain amount of equity in the deals. A lot of times people will come to us wanting 100% financing, and we're not going to be, the right people for that. We always want to see skin in the game, because from past experience, when you have somebody that really doesn't have too much equity of their own in the transaction, something goes wrong, it's very easy for them to walk away, and then we're stuck with the fallout. So, but if they're putting enough money down, then then they're going to stay in longer and try and work something out on their own if they can.
Yeah, and I mean, unfortunately, people that have walked away give us, the ones that, wouldn't a bad name, right? It's like because I mean, there's, I just borrowed quite a bit amount of money for a project, and I'm putting in my own on the rehab.
Yeah.
But as far as like the full, they still wanted to see you put something in,
right?
And I just think it's good practice, obviously.
Yeah, because the problem when we have done loans where, okay, the people didn't have a lot of money into the actual purchase, and they were going to do the rehab. Sometimes the rehab never comes about, or the rehab goes bad. We've had construction transactions where, the supplies, whatever, get stolen from the job site, or they're having trouble, getting permits, whatever it could be, but something goes sideways, and then nothing's getting done. So that money, we're not in control of the rehab money unless it's a construction loan, and if it's not, sometimes these projects never get built, and we've, in the past we have taken back properties half built or didn't get started at all. So you can listen to the story that, oh yeah, I'm going to do all the rehab and yada, 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 but it doesn't always come about. So if they're putting some, real money into the deal for when they do purchase the property, that, at least we know that money's really there, and then hopefully that the rehab does come about.
And, that's always been my biggest struggle on borrowing funds for the rehab, because I get it. I get that, the people lending the money want to see progress. They want to see, they want to do draws and all that stuff. But it's always frustrating for me, because a lot of times I do things out of order, or just because of the project or because of the crew I have available. So how do you do draw schedules? And if you do, how do you normally do them?
Yeah, we can, but when you do a draw, it's a little more expensive, because you have to have somebody go out and look at what's been done and make sure they're getting a permit for, let's say, the electrical work or the framing, and then you'll give them the money once that work is done. So. And then if you have cost overruns, you can have a lot of things come into play. So you just have to keep track of it as best you can. And what I've seen happen, not so much with us, but with other projects, people will run out of money, because when they get the construction loan in the beginning, they don't pad the quote for overruns, or just the price of materials going up. Sometimes if the project's going to take a year or two, what you quoted things for lumber, cement, other materials, even wages, and a year later or 2 years later, you're still, working on the transaction, and all of a sudden your budget is much higher, and they want to come to you for more money, and you just say no. So then they're out there on the streets, looking for the money, because they're short by 25, 50,000, whatever the number one might be. And you want to make sure that they have enough. I mean, some deals, if they're too tight and there's an overrun, it might cause a problem, in the future.
Yeah. Yeah. And it's always it's always how much padding. It's always an issue. You're going to rehab stuff. You never know what's going to be behind that wall, or try not to open the wall up, but you never know.
Right.
What do you like to see just one big pad on there, or like?
Yeah, we'll usually add. It's going to be typically about a 10% pad for cost overruns.
Yeah, I do the same thing like with wholesalers. Like if I see they give like an estimate on rehab. And if it's 50, I'm like, it's at least 80.
Yeah. Also, when sometimes you have, let's say, a rehabber that he's not that experienced, he hasn't done multiple deals. And sometimes even if they have, we look at like a fire damaged transaction, it's a flip. And sometimes they'll go in, they do their estimate, and then when they, let's say they need to get permits from the city, and the city inspectors look at the damage and say, no, this is too much. They want you to tear everything down and start from scratch. So all of a sudden, you take a transaction that went from, let's say, a $75,000 rehab to a $250,000 rehab, because the city's not going to permit for what you're trying to repair, because they just say, no, it's the damage is too much. And so that would be like a big issue, not only for the borrower, but for the lender and everybody else.
Yeah, what is it, like 40%? If it's more than 40, I don't remember what the percentage is. But,
yeah.
But yeah, if you think you're anywhere close to that, like, if you're at 42%, like I wouldn't bank your whole project on that.
Right. And so that's why you want to make sure, as a lender, that they have enough down payment if something goes wrong, and now the estimate is going to be a lot higher. And what if they don't have any extra money?
Yeah.
So, and I've seen, people just, they've walked away from deals, and yeah, they've had a little money put into it, put it as a down payment, but they got a rude awakening when they started the rehab and trying to get the permits and everything else, and the cost overruns just went out of sight, and they just walked away. So you need to be able to protect yourself.
Yeah, absolutely. As a as the person doing it and the lender, of course. I've never done a fire damage property. It's always, we've wholesaled them, but that just sounds like a can of worms that I've really never been excited to do.
Right.
So are you like most lenders? I think they, if you, depending on your experience, kind of depends on the deals, the rates, kind of stuff.
Yeah. I mean, if somebody, comes to me and they've done 10 deals in the past, 3 years, we're going to look at them a little differently than we are a guy who's like a first timer. We get a lot of first timers, and we'll still lend to them, but we want to make sure the down payment's sufficient, and we'll do our own analysis of the property. I know like parties will do what they think they can flip it for, but we have a different way of analyzing things. And if we, ever have to take something back and wholesale it ourselves, we want to make sure, and maybe with the changing market, if it's in an area where prices might be on the decline a little bit, we want to make sure, and for their protection too. I've talked people out of buying properties. I said, we can lend you the money, but I don't think you're going to make any money on this deal.
Yeah. And
we've literally talked them out of buying it, and they were appreciative of that. I mean, we don't like to turn down business, but then again, if everybody's not making something in the end, it doesn't work. Yeah. So we want to make sure there's going to be some profit left for them.
And you say that you do your analysis probably differently than maybe they did.
Yes.
What do you do that's different?
We'll just, when I'll talk to my appraiser, first of all, before they even decide to do the loan with us, and get his opinion. We'll look at our comps. I mean, we're going to look at, actives, pending, solds. We're going to look at the price range of what they're intending to sell it for. We're doing one loan today that actually it's way overdone for the neighborhood. We're signing docs today, but the person has a lot of skin in the game, and they're very experienced, a lot of assets and things like that. But if it was somebody that was like a first timer, because this property is literally twice the size of any other properties in the area,
which is a problem.
So, yeah, it could be. So, we wanted to keep our loan fairly conservative, and in the end, we'll probably be okay, because a lot goes to the strength of the borrower, and they are putting a ton of money into the deal, which gives us a higher comfort level. But again, if they were doing a flip, and this is not a flip, this is going to be a buy and hold. If they were flipping this property and putting minimal down with the properties that are all, like half the size, we would probably have an issue, making that loan. So,
yeah. And if you're out there listening and a lot of people, we see this more than you think, where, there's one house in the neighborhood that's just massive compared to everything around it. And it's like, you would think, that if you weren't an appraiser, you weren't in the industry, that, if there's a 1,000 square foot house next to it, and there's a 2,500 square feet house next to that house is worth like 2 to 3 times more than the one next to it. And it doesn't work that way.
No,
it doesn't work that way at all, because, that's not how the appraisers look at it. So,
right.
And why is that?
Well, because again, you need to have a comparable property, because when you go to sell and you have a 2,500 square foot house and all the rest of the neighborhood is 1,000 square feet, you got to think about who's going to buy that house. Somebody who's going to spend more money to buy a 2,500 square foot home, they want to have like properties in the neighborhood that they're buying in.
Or they just really love that street.
Yeah, or that could be true too. So so they'll in the end, and I have talked to wholesalers and flippers and things like that bought into some of these bigger, more expensive properties. They took longer to rehab. The market changed on them, or maybe they didn't figure the market correctly because of the comps, being smaller or cheaper. And in the end, they had to flip the property because they had so much money tied up in the deal. And they basically took a $200,000 hit when they sold it because, maybe they didn't look at it the same way as we would look at it, or maybe it was just like an unfortunate change in the market when you get into some of these more expensive homes, well over $1 million, and something can happen, and the number of buyers for, let's say, $1.5 million home are going to be a lot less than a $500,000 home. So if something changes or something didn't go quite right, you don't find the buyers that you need. What are you going to do? You're going to discount until, you find somebody that'll pay you, what you can get out of it for.
Yeah. Yeah. And that's, I mean, you nailed right there why for the last 6-7 years, we've focused on, sub $500,000 houses,
right?
And because we didn't ever really want to get caught with our pants down, on $1.5 million house when the market shifts.
Exactly.
And we're in the middle of one right now that the market's shifting, up there, and we're more into it than we'd like to be at the moment. But we have, at the moment we have about $100,000 worth of wiggle room. And, we're not going to do nearly as well on it as we thought we were, but, we're going to hopefully make something, but even if we don't make anything and get out of it, that's a win.
Right.
So but be buyer beware. Like if you're in a neighborhood where, there's something that's twice the size of everything else in the neighborhood, and you got the seller saying, dude, it's so much bigger, it's worth way more, like, or, the wholesaler or whoever. That's not the way it works with appraisals. So,
right. Or even cheaper houses. There's a realtor that I work with, and they have a client who's a flipper. He's got a property in Desert Hot Springs. It's, not too expensive, a little over $300,000, and they're having a lot of trouble selling it, even though it's completely remodeled. But, some people maybe don't want that area, or the floor plan of the property. And plus, it's this very small house. It's 600 square feet. So going from, let's say, homes that are overbuilt, what about homes that are underbuilt? And a 600 square foot house, and even though it's completely remodeled and the floor plan is kind of funky, they have a problem finding a buyer, even though the price is fairly reasonable. So it can go both ways, where the comps are mainly, let's say, 1,000 to 1,300 square foot homes, and all of a sudden you put a home in there at 600 square feet, and it's not what people are looking for. Yeah. So it can go both ways.
Yeah, absolutely. We did a flip in Moreno Valley about 2 years ago now, and it was in a 20-year-old track home neighborhood, but for whatever reason, this builder decided to do, these are like 2,000 to 3,000 square foot homes, and there was different models and stuff. Yeah. And then for whatever reason, this builder decided to, I don't know if they got affordable housing grants with it or something like that, but they decided to put these little, like, out of a track of, I don't know, probably 100 homes, they decided to put like 10 that were 1,000 square feet, like right next to the just sprinkled throughout the development. And that's what this project was. A wholesaler brought it to us, and I was trying to comp it out, and I'm like, because there was comps for all the big stuff, right? But there wasn't really comps for all
the little stuff,
and we ended up being pretty close to like what we thought it was gonna be. Went a little bit higher, but it's tough when the neighborhoods aren't cookie cutter, and they're all varying sizes. It definitely makes it harder to do. So, so what, when you partner, that's, the people that are new, like when you partner with people that are way more experienced, is it more of like just like, what do you want to see from people that are more experienced, as far as like, if you got a flipper that's not new, but new to you maybe. You want to see a packet of all their stuff. Like, what do you look
I
for?
mean, we want to see, like a resume of what they've done. We're going to look at the credit. We'll look at a couple of the projects that they've done in the past to see how they fared with those. And then it just basically boils down to the property itself. What does it need? How long is it going to take them to be in and out of it? How much are they willing to devote? The issue a lot of times with experienced flippers is they don't want to put, any money or very little money in. And
well, yeah, man, I got like 10 of these going.
Yeah, exactly. and that is still a problem with us because at some point things will change. I've been doing this, like I said, for over 40 years. And I've seen when the market, especially let's go back, let's look at the time frame of around, 89 to 95. That was a pretty a long drawdown with the price of homes. And then again, what happened in, 2007. So, we've had people that were very experienced and they took some pretty good hits. And, even with the experience, if the market plunges, let's say 30, 40, even 50%, there's not much, you can really do about that. So, I would almost rather take a newbie who's putting more down and then somebody who's experienced who wants to put like 10% down, because the market could easily turn 10%. And then you're relying on the credibility of the people that are doing the rehab to bail you out. And you never want to resort to that if you can help it.
Yeah, of course. No, that makes a lot of sense. And then like, have you ever been in a situation with maybe one of those experienced flippers where, they got a great track record and let's say just this one project's kind of going a little haywire. And by haywire, I mean, it's just taking longer to get out of than they maybe initially, thought. And let's say that loan's coming due. How would you handle something like that?
Well, we don't mind, extending the loan typically if the people are paying, and if they're not, then we'll obviously, we're going to have to pull the plug on the whole thing. But we like to try and work with the people. There's been times where, we've asked them to put some more equity in the deal to extend the loan. We've done that on occasions where the market has dropped and their equity position has dropped. But, mainly if people are making an effort and trying to pay us, even if they get behind, we'll try and work with them. I mean, there's some lenders that, if you're 30 days late, they're filing, an NOD right away. And that typically isn't us because we didn't make the loan with the intent to take their property from them. We made the loan so they can make a little money, we can make something, and, everybody can walk away happy. Now, it doesn't always work out that way. So, but, we will try and work with people. And there's been times where we've actually had to take over projects. There's been builders that, got in over their head, and we ended up, taking over the project. And so, but we'll always try and work with them first and see what can be done. And if people are making an effort, then we're going to make an effort and see what we can do. It's the people who all of a sudden ghost us. They don't return phone calls, emails.
And the project's half gutted.
Yeah, the project's half done. We're not getting any payments. Then that's when we're going to take action because, and sometimes they get a letter from us or they get an NOD, and all of a sudden it's a wake up call, And then, we'll get a call from them and, hey, we're going to pay you and blah, blah, blah. And sometimes they do. And, sometimes they don't. So, just like, okay, let's see what you're going to do. It's, we have one, that the people are behind. I mean, it's a 4-unit property. The property's worth over $1 million. They owe us $200,000. They're late on their payments. It's like, and they're not getting back to us. It's like you're getting rent. All 4 units are getting rent, way more than covers the mortgage payment. And why aren't we hearing from you, first of all? And then all of a sudden, we found somebody and we contacted them to contact the borrower, and then we get a call. Oh, well, you're going to get a wire, from them. Okay, well, fine, but why did we have to go through all that, aggravation and research, and I mean, we're not worried about it. I mean, they got, $800,000 in equity. So, and there's plenty of income to cover the payment, but still, and
it's frustrating.
Yeah, it's a little frustrating.
No lender, I've been on both sides, no lender wants to have to chase you down for money. It's just like I tell my residents and tenants and stuff like that. It's like, if I got to come find you, I'm not, it's not going to go well.
No, no. And the thing that people don't realize, it's just like owning a piece of real estate. If a deal goes bad and you have to file, an NOD and then the property goes to sale, and if you take it back, there's a lot of, now you're a landlord, and now you have to deal with all the things that a landlord will have to deal with. And that's not, what we're here for. I mean, we're here to lend money, collect payments, but sometimes it does get down to that. So, and the people that invest with us, we have to take care of it. We have to now manage it. If we're going to get a property manager, who we have some good people we can rely on, but we have to keep the deal going. Now, if there's tenants there, now we have to start collecting the rents, and now we'll probably look at becoming a wholesaler to take that asset and go ahead and market it, and just usually if we can get our money back, we're going to be okay with it. It's not like we have to make $1 million on the deal.
Yeah, you don't want to go backwards on the ladder. Because most people, right? Like most people, they start. If you have no money, you start off wholesaling. Then hopefully you get to flipping, you build up. And then you start buying rentals, and then hopefully equity. Long term. We're talking 10, 15 years here,
right?
Or faster. If you can. But and then you want to get to the lender stage. Where you don't want to deal with toilets and tenants and trash
Correct.
and rehabs and all that stuff. So it's not in your, like you just, said, it's not in your best interest to take a property back. You don't want to deal with the property. You just want to get the check.
Right. Right. But we don't want to take a loss either.
Yeah.
I mean, if we have to sit on a property, and wait, we'll do that too. But that's not our option A.
Mm-hmm. So if you can work out, if you can work it out with the lender, most lenders, I mean, I don't know. I've never missed a payment. I've never been behind, on any real estate stuff. So, but I would assume that most lenders, are willing to work with you,
Yeah, most of them are. I mean, some of them are very hardcore, and it's like you don't pay. They're going to file on you. You miss one payment, that's it. But, others, because, we're here, we're trying to build a reputation and things like that. And the worst thing you can do is be too hard on people, and then the word gets around, oh, don't work with this lender because, they're just after your property and things like that. You don't want that, to go out there, in the marketplace. And most of our clients are repeat clients. I mean, some of them, they've been working with us for, 20, 30 years because we'll do what we say we're going to do. We'll follow up. we'll work with the people, and, we'll stand behind our quote. We're not going to quote somebody one thing, and then when gets time, the escrow is getting ready to close, all of a sudden we jacked up our rate, we jacked up our fees, and put the people in a position where, well, now they're stuck. They need to close because there's deposits at risk, and, the lender knows that, and they know that. We don't want to do that. That's just not good business practice. So, we always try and just stick with what we quoted originally.
Cool. Now going back to, if people were experienced and they were going to put something in front of you, what was like the best one of those you ever saw? Like, was it a lot of pictures? Was it a lot of Excel sheets with all the numbers? Like, what do you like to see?
Yeah, pictures are great. If somebody's got, nice color photos of the property, that it really helps, especially on a rehab. And sometimes we can't even get in to see the inside because it's tenant occupied. We have no idea what the condition of the inside is. So then we have to be a little more conservative because we're just basing it on what we see on the outside. So we have to assume that the property inside is going to be trashed. So, the down payment may be a little larger, but yeah, just getting the photos. If somebody, has a title report right away, that's helpful. The basic, an application, a credit report, a couple of months bank statements to see that they have the ability to not only do the project, but make the payments. And then other things, if it's a rented property, we want to look at the rent roll. And then if they can give us a little history on them, if they are experienced, give us a resume, things like that. Yeah, that's all a big help.
Nice. Right on. Now, kind of pivoting a little bit, I talked to a seller the other day, and she's got quite a bit of money wrapped up in like over a couple $100,000 wrapped up in a concurrent first with like 12 other people. And the person that they lent the money to, I guess, is keeps claiming bankruptcy and then cancels the bankruptcy and then claims it. What would you do in a situation like that?
Really, to be perfectly honest, they need to seek legal advice.
Okay, of course.
I'm not a lawyer. I
told her that too.
Yeah, giving them legal advice, and that sounds like a big mess. Because first of all, what lender is putting 12 people on a deed of trust, and are they even have the do they have a securities license? Are they licensed by the DRE? There's so many questions there, and why is the person that's borrowing the money, why is he like in and out of bankruptcy, and how did they base their loan on in the first place? So
there's definitely a lot of questions.
Yeah, there's a lot of questions, and when I see deals like that, and I've seen people I knew who invested where 42 other people invested in the same note, and it was just a disaster. When the property went into foreclosure, the people filed bankruptcy, and I just told the people, they asked my opinion of it, and I told them, don't touch the steel with a 10-foot pole. And they still did it. Why? Because of the great yield. Well, it's like I told my dad once, because, God rest his soul, I would invest, some of his money. And I said, Dad, it's not the return on your money that is important. It's the return of your money. So if somebody's offering you like a 14-15% yield, there's a reason, that somebody's going to give you that kind of return, because there's more danger to it normally, much more risky. If you can, I would rather take a yield at half of that and a super secure deal with a lot of equity, good borrower, good credit, than something where, somebody's going to be risking, filing bankruptcy, or he's a first payment default. And then guess what? Now you got to deal with the bankruptcy court. That could take 6 months, a year, maybe even a little more. So again, when we're lending money, first of all, we're only taking qualified investors. Qualified investors have to have a minimum $1 million net worth outside of their primary residence, or make $250,000 net income per year. So that eliminates a lot of people. And because you get somebody who they have $100,000, they want to invest with you, but they don't have anything else really, and we don't want to take their money, because no investment is risk free. And somebody like that, maybe it's their first deal, they're not going to understand what's going on. They don't have the net worth, and it would be a pass for us, because people rely on us to look at the deals, make sure. Now, people sometimes think we're too conservative. Well, I don't think we're too conservative, but we're just conservative enough that we're going to protect the investors. And what I always tell people, I tell them, if I'm offering them a transaction to invest with us, I say, we're always putting our money in with you. We're not just soliciting funds from other people. We don't get first of all, we would never do 12 people on a loan. If it was that many, then the people are not big enough, not strong enough to take their money. You need bigger investors with more money and cut the number down. And then you want to really look at the borrower, and are they qualified to borrow this much money? And if somebody could file bankruptcy, or on the verge of filing bankruptcy that soon, I don't think anybody probably correctly underwrote that loan in the first place.
Probably not. And that's what I told her. I was like, I would, I'm not an attorney. I mean, they have, and it sounds like they have, attorney, but I don't know, maybe she could, sell part of her interest and get a little bit of her money back. I was trying to, it wasn't a small amount.
Right.
And she'd like to redeploy it elsewhere.
Right.
And she was kind of saying, maybe, you could weigh in on this. She was saying that she wants all of it back. And I was like, well, what if you could get, cause it was, let's say it was 300,000. So let's say you could get back 200, now, and then you could redeploy it, is that, or you want to wait 10 years to get the 300 back.
Yeah, exactly. And you may not get the 300 back. I mean,
might be 100.
I mean, I've seen people invest 400 and come back with 40. So they lost 90% of their investment because the investment was way too big. It went into foreclosure. Then the people filed bankruptcy. They ended up losing the property in foreclosure. And the problem became the taxes came due on the property. And guess what? People had all this money invested, and now the tax bill came due, which was huge because this property had appraised for $80-some million. So imagine what the tax bill would be like on that type of an investment. Yeah. So nobody was willing to kick in any additional funds, and then basically they ended up losing it, basically a tax sale, because the offers that they were going to get were not what they would consider, adequate for the money that they put in. But again, sometimes something's better than nothing. And if you're going to try and sell an investment like that to somebody else, it's already a problem. And the people who are going to buy, and there are potential buyers, but they're going to be vultures, and nobody's going to give you, 100% on your money. Yeah. So, they might offer you 50%, on your money. And because they look at it, well, why should they assume all the risk that you took without any, benefit? Because they could go out and find something else, something better with no hair to it. Why should they give you 100% return? So that's either you're going to stick it out or you're probably going to have to sell at a discount.
Yeah. Yeah, absolutely. Absolutely. So maybe, sorry, one more time to the camera. What was your dad's line?
Oh, well, I always would tell him, Dad, it's not the return on your investment that counts. It's the return of your investment. And, it was really hard for him to get that through his head because he was a yield chaser. And I saw him do this since I was 10 years old. I mean, that's when I started looking at trust deeds from what he was doing. And he was doing like third, trust deeds or even worse. And the yield was like really, really high. And the people would send a courier to our house to pick up the funds. That's how, badly they wanted the money. And, my dad, he never saw a penny of it. And I was 10 years old and I told him, Dad, have you really looked into this thing? And it's like, he says, they're going to pay me 18% of my money. Why do I need to look into anything?
Yeah, 18% of zero is still zero.
Yeah, exactly. And he never learned that. I mean, he made some good choices, but then he made some bad ones. And, but after so many, deals taking the hits, he said, well, now I'm going to listen to you. So it only took him, like 40 years for him to do that.
Yeah. Yeah. So it's not always about yield, right? It's
right.
It could be it could be a great yield and a poor investment still.
Yeah. I'll take a safe deal with a lower yield. I mean, I bought some loans recently from other people, and the yield was low because these were originated, a few years ago when rates were lower, but they were, super secure, good payers for many years, lots of equity, people with good credit. So it still far exceeded what I could get on a CD. And to me, it was as good as money in the bank, because if I needed to liquidate one of those investments, if it's a good one, if it's a good trust deed, there will be buyers out there that will, pay you full price. But if it's a bad one, the pickings will be slim, to find buyers and then what they're willing to offer you.
Now, a question for you, like if you were going to, let's say you were, well, not that were a lender, you are a lender, but if you were lending to let's say like an experienced, client that you'd been with for a long time, and they were paying you like 1.9%, on fix and flip loans, and they had a good track record, they never missed a payment, that kind of thing. Would you stick with them, or would you go chase, like, let's say 13, 15% on, mobile homes and parks?
Yeah, we'd probably be somewhere in the middle, because the first thing is people won't invest with you if they're not getting like a certain yield. And so
let me rephrase the question real quick. Let me, like, if you had to choose between those two types of people, you were at those numbers, like, would you rather stick with the person, or would you go chase the yield?
That's a really good question. We typically would rather stick with the people we know, but we'll see deals. I'm doing some loans for some new investors, and the deals are very good. Good equity. These people, lots of experience. I've never dealt with them before, but they seem to be pretty easy to work with. The yields are, very nice. And so I could do a loan with somebody else that is somebody I know, and sometimes the people really well, they want everything on a silver platter because they feel like they're really good, they're experienced. They almost want the funds for free. And sometimes a newer person, they're more reasonable. They'll give you a reasonable yield, and it's partly about the yield, because you want to get a certain amount of yield on each deal, and then some will be a little higher, some will be a lower, and overall, what's the yield of the portfolio, when it's all said and done, and if it meets your requirements, it meets the investor's requirements, what are they looking for, then, that's very important. But again, we always want to make sure there's enough equity in the deal and the people have the ability, to repay, and the collateral is still good, whatever it is.
Excellent. Yeah, I was just curious because, we're always, we have different lenders and we're always looking at different things, and, and we try and be fair, but it's good to hear from the other side too, because we lend also. So it's and it's tough. It's tough out there, because on the one side you're like, well, always never missed a payment, you've been doing business all these years. And then on the other hand, you want to try different people, and, newer people want to get in the game too. So
right.
It's always, I'm curious on your dad's stuff. Did you ever look at his books and figure it out, and how much he had, what his true yield was?
Not really. I didn't, we had another family member that was handling, most of that. So, I gave him my advice, and sometimes he choose, to invest with me, and sometimes he went elsewhere. And I could tell you the ones he went elsewhere, it was kind of like 50-50, 50% turned out pretty good, 50%, maybe not quite as good. So I just looked at it as, if I'm going to invest, my dad's money, I want to make sure 100% is doing well. And, if the yield was not as high, but the security was really good and the deal was really good, we would always tend to go with that. And he was okay with that, if I was doing it, because he knew he was always going to get paid, and paid on time. And, my dad was a stickler. If you owed him money and it didn't matter how much you owed him, he'd be on the phone with you. Hey, I didn't, receive that check for $100. What's going on? So you never wanted to get that call from him, because, even, into his later years, he was still pretty sharp, when it came to money, and he knew what was going on and who owed him what.
Nice. Yeah. I don't even have that many out there, but you tend to know.
Yeah. And he had, he kept everything manually. He had his little notes, he had he had really good printing, and he'd print out a whole big schedule, details on everything, every payment. He would come back to you and he would reference all this paperwork from 20 years ago. And, oh yeah, wow. Guess what? There's still $10 outstanding here. Do you intend on paying it out? Wow. I didn't realize, that was still owed, but here you go. Here's the $10.
That's cool.
Yeah.
Well, hey, that's cool. He may have been a yield chaser, but it sounded like he was good on his, his bookkeeping and all of his, he knew it all.
He was a Depression era, person, and he knew from his parents and everything and the surroundings growing up, he knew how to manage. He didn't have a lot of money, but he knew how to manage what he had. So kudos to him.
Right on. Well, that's I'm sure that's was great to grow up with and see all that, and even if it was sometimes an example of what not to do, that you were you're very exposed to that and at a young age. So
right.
That's cool. Well, Steve, we only have a few more minutes. I do have a question for you. If you want to say it to the camera there, we'll try and get a good clip of you for the social media out there. What's the number, the two top things that if you were looking for money that you could do, and then the two don't do this kind of things if you were looking for money?
Yeah. I'm just saying, if you're looking for money, if something sounds too good to be true, it probably is. So, I passed on a lot of, deals myself. People want me to invest in certain things, and and also, when you're too far away, as far as too many people involved in the investment, and it's like who's managing it. I tend to stay away, from things like that. I want to be within arm's reach of whatever I'm investing. I think that's, very important. And then just really know like the people that you're working with. I've had like work with the same people for at least 20, 30 years or more. So if somebody new, you've never met and has this great investment, it's foolproof and guaranteed and all this, just be careful. I'm not saying don't do it, but you better vet it out very, very carefully, because, you don't know these people from Adam, and people will tell you anything if they're trying to raise capital. So just, because once you, sign over that check, it may be very hard, getting your money back. So just be careful about, who you're dealing with.
Yeah. Right on. Well, cool, Steve. If people want to either borrow money from you or talk about real estate or whatever, how is the best way to get a hold of you?
Yeah. So as far as if you're an investor and you want to diversify and invest in notes, and you are a qualified investor, you can, give us a call. We'd love to talk to you. And if you're just a client that is looking to do a flip or wholesale or a buy and hold, or, just want some advice, call me for that either. Or if you're a first-time buyer, you want to buy a house and you want to take advantage of some of these, programs out there. If you're a senior looking to do a reverse mortgage, we can help you with that. And then if you want to just get a HELOC, you have a great first mortgage, you thought about refinancing, but you don't want to touch that great first mortgage with a 2 or 3% interest rate, we can offer you a HELOC, which you'll, keep that first in place. So my number is area code 562-818-3502. That's 562-818-3502. And best thing is actually go to my website at financialbrokers.net. That's financialbrokers, brokers is plural, .net. And then you can see a list of all our disclosures and licenses and a little bit about our company, Peak Finance Company, and some of the different things that we do. And, we'd love to talk to you. There's no obligation. We get calls all the time. People are asking us things, as long as it doesn't involve an attorney, because we're not attorneys and we're not giving legal advice, but I am, a licensed broker. And if it's something that I can help you with, I'd be happy to assist you. So thanks again for having me on, Rich. And I want to just say, everybody here appreciates what you do at the club. You invest a lot of your own time, effort, and money that, you're not taking a salary. You're making this club available to people, a lot of newbies that I meet here and a lot of experienced people that if they didn't have this, they wouldn't have a place to go, and you make that all possible. So again, I want to thank you for doing that, and that's why I really love being a sponsor of this group.
Awesome, man. Hey, thank you so much.
Sure.
Appreciate that.
Yeah.
So, and thanks for coming on the show. This has been the Fire Chat podcast hosted here at the IEREIC. If you want to get more information about the club, we meet 3 times a week now. I think it's like 13 times a month, actually. We do some weekend events. We're actually having an event here in about a few hours for some tribe networking, tribe building. And if you want more information on all that, you can go to firechatpodcast.com. Again, that's firechatpodcast.com. And thanks for joining us. We'll see you next time. Thanks, Steve. Thanks, everybody.
Thank you. Bye now.